Are you ready to take your first steps towards financial freedom by investing in property? Whether you're a first-time investor or you've started your portfolio but need some help continuing to grow, 2022 REB Buyer's Agent of the Year and Rising Star finalist Lachlan Vidler and his team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take your next step in growing your portfolio. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment property. Visit atlaspropertygroup.com.au to book in your discovery call absolutely free of charge.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. Tuning in, wherever you're tuning into this. A lot less people in cars these days and trains with this work from home type thing, and a lot of property investors, they were coming from all shapes and sizes. Knowledge workers rather than... That's the new sort of white-collar worker, I guess, versus your blue-collar worker. A lot of blue-collar workers investing in property, wealth creation, and you hear really good stories of people sort of tuning into this, whether they're on the end of a shovel or in a warehouse or a factory, listening to the Smart Property Investment Show as they're working. Hope you're enjoying yourself. Thanks for tuning in for all those guys and girls and also those knowledge workers out there tuning in. Best thing about podcasting is you get to choose when you listen to information and content that you're interested in, and I'm finding that in this particular market, there's a flood of people, new people sort of tuning into the Smart Property Investment Show, trying to get some sense for it all. We've been told for the last 2 years, quick, hurry up, invest in property. And the last sort of 3 or 4 months have been told, don't do it. It's a bad asset class. So people are trying to make some sense for it all. And if you've been in property for a little while, you know this. And if you're new to property, get used to it. People will always have an opinion on property, irrespective of the market cycle. And your taxi driver or your Uber driver will have an opinion. Your person that makes your morning coffee will have an opinion on coffee. Your uncle at a barbecue will have an opinion on property. Typically, after a few too many Forex golds, this is the way it is. So be very, very careful where you get your information from. Make sure you have many different sources of information as a property investor, but be very discerning about what you choose to listen to. And even more importantly, what information you actually act upon. And that is what is the difference between a mediocre property investor and what I would say is a smart property investor. So the fact that you're tuning in means that I'd like to think, tuning into one of the more reputable sources of information. No bias or agenda here other than trying to help you make more informed investment decisions, because I still see people, having done this podcast for many, many years, making absolutely fundamental schoolboy errors, which are completely avoidable. So if it's too good to be true, probably is too good to be true, and that's just the way it is. Fortunately, in Australia, we've got two emerging sectors which are the heartbeat in many ways behind property investors. Number one is mortgage broking. Most recent numbers, nearly 70% of all home loans in Australia a month or so ago, June, May, were written by mortgage brokers. There's a big tick on my side of things. It means more Australians are actually understanding, appreciating the capabilities of a mortgage broker, helping them to find a more appropriate loan rather than going direct to the bank. And sitting on the other side of the equation, but highly connected in with that, is our buyer's agent sector. Again, still growing rapidly, and they're coming into their own right now as we move into this more complex, complicated market. One of them is Arjun Paliwal, good friend of Smart Property Investment Show, director and head of research out of InvestorKit. He's also one of the 2 people behind Property Nerds, which is a podcast gets syndicated on Property Investment Podcast Network, probably where you're listening to this as well. One of the buyer's agents I turn to for a real good sense of what's going on in the world, particularly in his beat. Arjun, how you going?
It's good to be on, my friend, and definitely out of the 2 that you mentioned in the Property Nerds, I'm not the better half. So,
how is the Property Nerds going? You're nerding out?
Definitely, that's the key, right? I think the main thing is by the way, everyone who has been taking time to email, call, really appreciate it, because it really makes us feel like, hey, we're on to creating that safe space that we wanted to, for fellow nerds to feel like they can go to a space and just tune into all things data, not feel like they're either boring someone else or hopefully we're not boring them, right? So, and I think that's been the big take out of the Property Nerds, that there's a safe space for all things property data.
It's very good. And I must admit, I'm a bit of a nerd in a number of different areas. For those of you that know me will know what I mean by that. But maybe the public persona doesn't pay me as a nerd, but I'm pretty nerdy, or I can get involved in nerdy stuff, academic stuff, and I do quite enjoy it. The question I've got for you, Arjun, there's a whole bunch of things I want to talk to you today about, one of them being what's going on with Queensland land tax. Also want a bit of an update on your portfolio. I know you're a prolific buyer of real estate yourself, and there's normally clues in what Arjun is doing, what he's also getting his clients focus on. But back to data, I do a regular live stream with Tom Panos out of the real estate sector, real estate coach, auctioneer, and he's definitely one of the people I listen to when it comes to what's going on with property markets. Now, he reckons that we're already 6 months through this negative, the softening real estate market, which is running in parallel with a rising interest rate environment and all those other things complicating it. He's saying that we're already 6 months in, and it's probably going to be 12 to 18 months. So we're a long way through this cycle already, where a lot of people think it's just starting. But the data isn't yet showing exactly where we are through this process. Being a data-orientated person, one of the property nerds, someone who makes a lot of decisions on data, how do you sort of get the balance between the ground truth you're seeing as a buyer's agent versus the data coming through in this sort of maybe 2-3 month lag between it? Are you able to dissect it and pull it apart and actually understand what's happening? And what would you be the tips to people to try and do the same? Because if you're making decisions on today's data, it's probably already a bit softer than where it really is.
Yeah, it's a great call out on the downsides of data. It's a clear downside that still has room to improve in Australia. But the first thing I want to touch on is what Tom mentioned in that chat with yourself. 6 months. It's a very good call out, because many people have just been drawing the curve of interest rates, drawing the curve of this change, and thinking it's this exact piece. But our biggest markets, for example, Sydney and Melbourne, did show signs of slowing far earlier in the year, even towards late last year, which means that was prior any interest rate jump. So that's one core thing. The second thing is on the ground truth. There's the beauty of that. And as a national business where we're able to see contacts all across Australia, multiple states, and get the today or this weekend's or last weekend's ground truth, there's a clear piece that all over Australia, there is a slowdown on the demand side.
So there's a slowdown in demand. And does that sort of exacerbate a slowdown or a softening of prices, or there's just a slowdown in demand of people buying, and therefore the inherent outcome of that is supply and demand? There's less people wanting to buy, and therefore prices aren't going up.
It's mixed results everywhere. And the first key part is that demand being one equation. The beauty of the housing market, and the most challenging part about it, is that I love getting so deep into the data, and there's so many things to review. And why I have so many things to review is because there's never that one thing that causes property markets to go in X direction or Y direction. So we all talk interest rates and sentiment. Well, we've been working actually on a research paper that's due to come out end of July. It's going to be the deepest paper on Australia's housing fundamentals that exist in the market today. And that one will have 28 fundamentals we're reviewing, of which right now 75% of them are positive, which means that the interest rates are negative, the sentiment changes are negative, and that's obviously weighing down the demand, which you've mentioned, Phil. On the supply side is where you'll see the varying pieces. You've got some markets where their supply is 5-year equilibrium. So what that simply means is that for the 5-year listing trends, they're back up to their norm. So there's no crazy shortage. But there are other markets that have a 40 and sometimes even up to 60% decline in listings from pre-COVID. So the key thing is where one market is seeing supply lower, the other at more balanced, even if demand drops off, one may grow, one will grow, and then the others will soften up and decline like you're seeing. So main story of the whole change and what you've seen and picked up from the discussion with Tom is that gone are the days of blanket approach capital growth, which everyone's had the luxury of, where everyone, everywhere, everything gained a lot of money over the last couple of years. So now we go back to those pre-COVID, which markets have solid fundamentals to continue on.
And there is markets in Australia with solid fundamentals.
Correct. Well, if you've got 7.5 out of 10 fundamentals, or every 10 fundamental pieces that we're looking at positive, 75%, there's obviously some pieces to the puzzle in Australia that are clear.
So give me your personal sense of the rhetoric and the noise around property at the moment. It's getting beaten up again as an asset class that is not investable. on the other side of that, people are talking about greater affordability for first-time buyers. So it pulls at the heartstrings of Australians' wealth and Australians' emotion, property investment or owner-occupying. Do you have any real, having done the maths and looked at the data, do you have any real concerns about a property market crash?
Yeah, that's actually a very good point. So let me go through a few fundamentals to share what I'm seeing and what we're feeling. And this will paint the picture of how do we even get to a point of where we think 75% of Australia's housing fundamentals are intact. The first is if we look at people movement, and I divide into a few categories: people movement, economic activity, finance, affordability, supply, sentiment. So when we break it down, people movement, there are weaknesses and opportunities for strength in the future. And by people movement, we talk population. So long-term averages, or not super long-term, but 26 to 21 averages of population growth are in the strong column. If you then look at that COVID blip and where that's left us now, though, from an international migration, it's fairly weak. Now, that represents an opportunity because we know where Australia can get to if it comes back to its glory days. That puts pressure on rental markets, which is not currently seen yet, and even then, rental markets are extremely tight. If we look at internal migration, that's just shot up like no tomorrow. Yes, it was always a previous trend prior COVID that was moving positively, but now it's continued to remain strong. If we move over to economic activity, unemployment rates are some of the lowest we've ever seen. Job advertisements are some of the strongest we've seen, and infrastructure pipeline are some of the largest that we've seen in terms of 200-300 billion plus in spend across the country. Then we start to go to the finances column. Here's some weak parts. The cash rate's sudden change. That's not a weakness in where the cash rate is. It's the sudden change that's obviously shocked many households with sentiment. Now, we expect that to continue rising just with what some of the inflation data that's coming out, but I don't expect it to be a forever. I do see it being a temporary phenomena just to try and find that balance, because it's the only tool our Reserve Bank has at this stage to basically say, we want to try and slow this thing down. Moving on to other core factors, household savings ratio, 11.4% in the current average, extremely strong. So we're cashed up. Household incomes are trending up. New loan commitments, so the money flying around Australia, is at extremely high levels. And then we start to look at loan-to-value ratios for Australia, 21.1%. We're not debted up as a country like many believe.
So just on that, so of all property in Australia, 21% of it has a mortgage against it. Well, there's debt against it.
Yeah, debt against the overall value.
The overall value. So 80% of property in Australia, residential property, doesn't have any debt.
So it's not about 80% not having the physical debt on it. It's 80% of the total value not having debt on it.
Which is pretty strong.
It's amazing.
Yeah.
And the interesting thing about affordability is that's going to be a forever debated topic. Now, I don't want to show your age here, but if you could go back many, many years, you'd see as well that affordability was constantly a discussion.
It's always there. You pick up any paper from whenever and it say, it's so hard for young people to get into the property market.
Well, the beauty of census data shows that we're getting into it at a somewhat similar rate to what we've always been getting into it. And that's just released now. We're not talking super lag data. We're talking that 64-65% of ownership that Australians have. Look, there's a lot more fundamentals here, but long story short, there's about 75% of Australia's fundamentals show strength. The clear weaknesses, though, are people movement. We still don't have the people coming in, even though our borders are open. Number 2 is the rate of change in cash rate. Number 3 here is our price to income ratios. Again, it's not a fully super meaningful metric, but it is a metric to be concerned about if interest rates continue going. The third metric here is our consumer sentiment scores. So these are some of the weak fundamentals currently. That's not a lot. If we're talking low supply, if we're talking strong household balance sheets, low bank delinquency rates, strong investment, strong economy, strong jobs, there's more for in Australia than against, which means that I don't see a price crash that's going to be long-lived or going to be extremely impactful to many.
Okay. So you heard it there from Arjun. Steady as she goes then.
Yeah.
That's a catch-all. Steady as she goes.
Yeah.
Be aware, not alarmed. And if you're investing in property, it's always a good time to be doing it when you can invest in property. Arjun, there's a couple of things that you spoke through there, and it just got me thinking around asset selection and locations, which I want to have a chat about. We'll just go to a quick break. Stay with us, everyone. We'll be back with Arjun in a moment.
Ever wondered how you can invest like the top 1% of Australian property investors? Henderson Advocacy has been at the forefront of helping everyday Aussies improve their financial freedom. So if you're a savvy investor or someone just starting out on their property journey, give Henderson Advocacy a call today. Head to www.henderson.com.au. Don't invest alone. Invest smarter.
Welcome back, everyone. It's Phil Tarrant, host of the Smart Property Investment Show with Arjun Paliwal, Director and Head of Research over at Investigate. Now, Arjun, two things I want to chat to you about. One is Queensland land tax. But before I get there, it's something you spoke about prior, the investability of certain suburbs. And I think about Sydney because it's very immediate. You know, we've just had another 1 in a 100-year flood within 3 months of it flooding, but another 100-year flood. And I'm thinking maybe around the Hawkesbury area. So I know sort of, you know, the hills, you know, the western suburbs of Sydney pretty well, heading out towards like Windsor and Richmond and those particular areas. Now, I was watching a Four Corners piece the other day, and it was sort of saying, why are we building properties on floodplains when these weather events keep happening and these places are going to get flooded? So what's your sort of catch-all view towards investing in areas that have propensity for flooding, even though it is 1 in a 100 years? Do you not touch it at all, or you're discerning around it? Can you give some sense for investors about how to tackle that? The western suburbs doesn't flood all of it, but there is parts and pockets of the southwest Sydney and western Sydney and northwest Sydney which lives in floodplains. Your views, opinions towards that?
I think the first thing is you touched on the main part, which is parts of it.
Yeah.
We got to recognise that very few cities across Australia are completely safe from any sort of disaster, right? From bushfires on one angle to floods in the other, to economic diversity or lack of economic diversity and seeing carnage and people leaving a city if anything happens to certain industries. There are risks in anything when it comes to our shelter, our houses, and so forth. So if you recognise that and you act with diligence on the parts of it piece, that's going to be the first component. The second component's quite interesting, and I know it doesn't sound as something that, you know, many people would at first agree with, but it's V-shaped recoveries. We analysed the markets of Cairns, Townsville, and various other cities that saw lots of impact in the past. They say 1 in 100 years, but it was far more frequent in these cities. We're talking a very V-shaped recovery. So by that, we're meaning impact, uncertainty, displacement, damage, then spend, back to replacement, and then back to living, all in a short period of time. So I'm not saying people don't get impacted, but in terms of a structural market shift, don't expect it to happen simply because of that, because of the V-shaped recoveries we've seen in the past. Unless it got to such a level where like half a city no longer exists forever, that's obviously, you know, carnage for many.
There's some cities or some places they're thinking of moving the towns like Lismore CBD that talking about moving it completely, and what that means for anyone that's invested in property up there, I don't know. But are you better off not investing in flood-prone areas, just be on the safe side? Because you might be able to get in for it cheaper, but there is an inherent risk around it, and also insurance is difficult to get right.
Yeah, I think flood-impacted areas, like impacted properties, I wouldn't think about going, you know, I see this often in Brisbane. You see a flood map that absolutely hammers an area or property. The area might be okay. You could have bought a property down the street, but you realise that property is outside of your budget.
Yeah.
Many people go, hey, 1 in 100 years, if it booms again and I'm still here and I cash out of that boom.
Roll the dice.
Roll the dice, let's go. And so they go all red 21 and essentially realise that, hey, maybe it wasn't the best decision. That's where you want to avoid at all costs.
Yeah.
But when it comes to the city itself, I don't see you feel like the Townsville and Bundaberg and Cairns examples. I don't think there's merit to say that you should never be in these cities, because even with other things like insurance is increasing, everything catches up to relativity, right? So rents increase, things cost more. You place more pressure on a household, then the costs are alleviated by other ways, which is rents.
Yeah. Anyway, it's very immediate, and these 1 in a 100-year floods, I think, get used to it. They're talking again. I think in Sydney, September, they're forecasting out in the Hawkesbury area another big flood. So buyer beware. Be very careful if you're putting your money in those areas, particularly for property investors, owner-occupiers, of course, but put your money in the right asset. That's the secret to property investing. Now, Arjun, this is to another point around location, and I've mentioned it on the podcast in passing last week or so, and I'm still trying to understand this completely, and there's still a big what if around it. The Queensland government making noises around changing the way in which they're going to apply land tax inside of that state. Now, from my read of it all, they're pretty much saying, like, right, I've got property in Queensland, everyone knows, and I have it in different trusts, and you get thresholds in trusts around land tax. What it looks like the Queensland government is doing is that they're just going to say no more thresholds, and we're going to consider your whole Australia-wide land holdings as a basis for setting your land tax inside of Queensland. And importantly, they're not going to grandfather it. So it's not like, hey, from this date, this is when it's effective. They're going to be doing it retrospectively for all property investors. It's a big deal. You know, maybe my understanding isn't as clear as what it should be. What do you know, mate, so far?
Firstly, I imagine just what's going on in that boardroom meeting where everyone's talking about implementing this so-called great idea. And I just think, have they not learned from what's happened across Australia and the rental market over the last 5 or 6 years? It's extremely disappointing on that first note, which is the people that we're hoping to positively impact from these policies point the finger on the investor and end up helping those who want to get their foot in the ladder. We're hurting it much more. It only takes you to catch a 3-hour flight across the ditch to New Zealand, my home country, and just see how much rents are increased there. They're far worse than what we've seen here, and they're far higher than what we've seen here.
So you're saying that if they apply additional costs to hold property inside of Queensland, all property investors are going to do is just put rents up?
Well, no, it's not going to be that simple. It's going to be a two-part piece. Number one is many mums and dads who aren't prepared to see this out or are going to sell. Knee-jerk reaction, I need to get out of here.
Yep.
Hate this, hate that, stop it.
Yep.
Don't want to impact my family anymore. The outcome of that is that the new investor is also conscious of this thought. So now the person who sold is out, the person who's getting in is now going,
not too sure.
And each transaction now is replaced with an owner-occupier, which is, it has its own positives.
Which is what they're trying to do. They're trying to make, because I know there's a rental crisis in Queensland, so they want to make more houses available for people to buy rather than renters.
Well, see, the funny thing is it does the opposite, because now what's going to happen is that, yes, there'll be those opportunities to buy, but the pool of rental properties gets smaller and smaller and smaller, and as a result, rents will rise.
Yep.
The second part for rents to rise is actually an environment of low active supply, and conditions are already there. Queensland's already amidst the rental crisis, so we will see rental crisis 2.0 from the actual outcome of this policy. But in terms of what I'm doing, what maybe investors should consider and just think about for a moment is actually beyond the short term and policies and having these knee-jerk reactions. It's to kind of think of 3 core steps. Step 1 is if it goes away in the next 12 months, which is highly unlikely, but if it does, what happens then? Did you make a knee-jerk reaction you're not happy about? Could you have seen that market cycle much longer? Step 2 is now 12 months are up. Still not gone, it's still stuck to you, and another 12 months are gone, and the first year hits, the first bill hits, it's not looking pretty. But again, if it's still not gone by this time, welcome to step 3. The rest of the country, the rest of the state governments see it as a money-grabbing opportunity, and they want to all get in on it. So you then making these knee-jerk reactions to get in, get out, and start reallocating your positions, all of a sudden, it's back to square one again, and you maybe have bought and sold not the right times.
Yeah. Look, there's still a fair bit of water to go under the bridge on this, and we're trying to get some sense for it all, and we'll try and get someone from out of Queensland government to come over yarn with us about it, trying to actually work out what they're trying to achieve, and if they're trying to decrease the attractiveness of property investors buying Queensland property, be very careful where you tread, because to your point, Arjun, you know, a third of Australians own their own property outright, a third of Australians have mortgages, and a third of Australians rent, and it's probably not going to change that much. So if property investors aren't providing rental accommodation for Australian renters, well, it's going to fall in the hands of the government to provide that.
And their trend is going down,
They don't want to be landlords, right?
Yeah.
So they should be encouraging property investors to support property markets in Queensland. But the argument being, well, there's so many property investors in Queensland, it's pushing up prices, which is making it unaffordable for Queenslanders to buy homes, right?
Well, see,
it's a real catch-22.
The data doesn't lie, and census keeps telling us that, hey, we're not any more crazily investor-loving or investor outcomes from 4 years ago. It may feel like that, and the rhetoric is that because prices are going up, but the true reason is we were on track to have a dwelling deficiency pre-COVID, heading into COVID. It's just all that monetary supply and stimulus boosted it that second part. But we were always going to see increases in prices in these last few years.
So how big a concern is that, this lag in dwelling approvals and construction? Because we were behind the eight ball pre-COVID. Now we're definitely behind the eight ball, and that's exacerbated by, cost of materials, access to tradies, all this sort of stuff, right? We don't have enough people to build the stuff that we need to get built, let alone thinking for the future. So how big an issue is that? And I guess it's probably not bad news for property investors, because if there's less dwellings for the people who need them, that should have upwards pressure not only on rents but also property values. But the negative of that is that there's a lot of people going without.
I think the established prices are getting a kick more than they typically would because of that lack of choice, the lack of trust, the lack of faith in seeing that new build process come out. We will have a period that as these supply issues or construction-specific issues ease, there are a lot of approvals in the pipeline that actually haven't traveled all the way to completions. So that should ease some amount. But is it enough? Has it been approved for long enough? Is the approval pipeline spiking long enough? No. So we are in for some more dwelling deficiencies over the years ahead.
There you go. Well, maybe something for us to get into detail in another podcast. But Arjun, I know you practice what you preach. You've got a pretty considerable portfolio with some new purchases. So I just want to chat through some of them. We'll just go to another break, everyone. Stay with us. Back in a moment.
It's time to get help. Interest rates are increasing. Inflation has hit an extraordinary 5.1%, and the chance to secure a golden egg property is getting narrower by the day. Dragan from Buyers Agency Australia has been presenting the facts and helping property investors make smarter, well-informed, educated decisions in property for years. So, what are you waiting for? Get in touch with Dragan today at www.buyersagencyaustralia.com.au. Invest with integrity.
Welcome back, everyone. It's Phil Tarrant. I'm chatting with Arjun Paliwal, Director and Head of Research at InvestorKit. How old's InvestorKit now, Arjun?
Well, we're going to have the start of the fifth year, this 23rd. We move on to the fifth year.
5 years.
Yeah.
I remember chatting to you when you were working at the Commonwealth Bank. Did I get that right?
Yeah, you didn't have any grey hairs back then, did you?
No. It's sometime. It's working in property, mate. It doesn't help.
I think I grew a couple as well, to be honest.
No,
so
good,
they're
mate.
creeping up.
Yeah, you happy? You would never look back? Would you do anything different?
Look, never look back. I think it's a combination of passion, expertise that's been building, and real impact. On that impact note, Phil, like a couple of milestones have happened for me and the business personally, where I looked back over the last few years, and honestly, it's lit another fire under me. And I just want to, help many more as a result. The first thing is that just over 1/3 of all our clients own 3+ properties.
Okay.
That ATO data suggests it's 8 to 10% for Australian investors. Yeah. The second thing was
so 8 to 10% of Australian investors own more than three or more property.
Or more in personal names.
It's not a lot. That's of investors, not like of all Australians. That's like it's a tiny fraction.
There's still that skew in the data of trust versus no trust capturing.
Yeah,
that's
true.
always going to be there, but we go with the data we have, right? As for us, that was that number. But the second number was actually, it can only come from years. You don't see it in the first year. And what the second number was reflecting on the boom. Because I get moments sometime when you go home and you look at all the charts and everything you produce and you feel good about yourself, but then you get a moment and you're going, but everywhere's booming. And then a moment of realization comes in and goes, hey, hold on a minute. Well, if we feel like we're doing it right, it should be outperforming that boom, shouldn't it? And that's what happened. We looked at the last 3 years of bank valuations. We looked at the last 3 years of Australia. And ABS's Q1 2019 to Q1 2022 was just over 41% in capital growth for Australian houses. Our clients achieved 56%, which means there's a 30% outperformance. So on that note, the last 5 years have been the best of everything, only because I can now look at it and go, I have the hindsight to be able to say there's genuine impact, and I can't wait for the next 5.
That sounds cool, man. And your passion for property investing yourself hasn't dissipated. You're still at it. What's your portfolio look like these days? Can you give us a quick sort of
Yeah,
check in?
So we've got 16 properties between my wife and I.
Yep.
Just under 10 mil in value. And when we first, started was 2015, so 7 years of building that experience across 5 states and 2 countries.
Okay.
And so as a result of, just doing what we, like you mentioned, preaching and practicing all of that together, we made a few purchases in recent times, some by accident and some with full intention.
What sort of LVR are you operating on your portfolio?
I think the debt levels right now are just over 5 million.
Okay.
Yeah.
So you're sort of 50% LVR.
Yeah, just under 55.
That's pretty conservative for someone still relatively young, but no doubt you got this dual levers of creating wealth through property, but also building a business, right? It's a handy thing, and building a business is obviously a big focus of you right now. How do you go about managing? So I know what it's like. It's a headache. How do you go about managing that many properties? Who does it? Is it you?
Actually, yeah, it is. It is me.
Do you spend much time on it each week?
I don't.
No.
I've really try and make sure I have my new financial year as a reflecting point.
Yeah.
So I do kind of have this trigger happy. If you're my managers, listen to this. Please don't listen to this part. I have this trigger happy approve for everything to do with my property, just to kind of look at it in July and then reflect on the year and go, I gave it a good 12 months. What worked, what didn't.
Yeah, so it's a good point. You should be doing this. I'm doing it myself right now. I'm using start of the financial year to do some of the sort of administrative catch up on it all. How's your mortgages on at the moment? You're operating sort of variable P&I, interest only. What's your sort of debt structure on it?
Well, interesting, the mortgages, you just gave back a little bit of a memory to me. 2018, I probably made one of the worst decisions, but in prior, I felt it was the best decision. Fixed rates for 4 years.
Everything, yeah. God.
So I just came off them earlier this year or late last year, did a good portfolio refinance, got some interest onlys back in.
Yeah.
But at least the good news is I don't get surprised by these rate rises because I was always traveling high fours.
Anyway. Yeah, God.
I was banging it out, high fours interest rates, never saw a 2 in my life until the recent refinances.
Yeah.
So as a result, I got stability, which is great because I did leave my job, 2018 in the banking world. Yeah. So that was wonderful. But hey, at least I don't feel unprepared for what's happening.
Did you refix anything or you left it all variable interest only?
Because of, the fortunate success of business and everything as well, we have been kind of keeping a lot of stuff variable, have stuff in offsets, have some good buffers, and a few things we had rates that were just absolutely too good to be true. So we're just like, hold on a minute, we've got to fix this.
Got to fix it up.
And we had that.
And in this sort of rising rate environment, variable rate mortgages, you do have the flexibility around it, but with an offset connected with it, offsets are a beautiful thing. You're just decreasing your exposure to debt and only paying debt on what's outstanding. So I love offsets. I think they're great. Now you're getting sort of 4% on your money, right? Try and get 4%. 4% being it's interest you're not paying, so therefore you're getting 4% saving on the money that you have in offset, and it's completely liquid as well, so you can use it when you need to. I think it's a great thing. If you're not using offsets, redraws to some extent, but offsets get stuck into it. If you don't know what it is, go and speak to your mortgage broker because they're really, really cool. Basis is, if you've never heard of it, if you've got a $100,000 mortgage and you have a $100,000 sitting offset account, you don't pay any interest on what's outstanding. If it's a principal and interest, you'd still be paying the principal component off, but you're paying no interest on it. So go and check it out. Now, Arjun, 16 properties, that includes some new purchases. I hear you've been buying in regional Queensland. Yeah,
the first of the most recent purchases. So I think the last 2 acquisitions were in Townsville and Bundaberg.
Okay.
And the first one in Townsville, there's an interesting story to this, Phil, and I've actually shared a similar story with you going back to 2020. And it was the moment where something unfortunate's come up for a customer, and I obviously back the location, the deal, and our recommendation, and also want to support my customers' position so they aren't financially impacted. And I pick up the place.
Okay.
So what the story was is an interesting one. We had an off-market in Townsville earlier this year. Presented it to a young first-time investor. He fully backed us, supported us, and we supported him on this journey, and he picked it up. As a result of what happens, though, is building and pest time comes along. He's very new to this, and it's part of his learning journey. And a few things come up that need a little bit of love. Now, as we do, the first thing we do for our clients is let's just let them have that time to review it with the inspector, review it with themselves. Then the second thing was to go in and negotiate. The beauty about Queensland contracts are you're well into it, you're well into a few weeks, and you do have that opportunity on the power sitting with the buyer to make these requests. That too on an off-marketplace. So we made the requests, and I did not believe this, but the seller said, we'll do everything. Now, that's great news, and everyone must be thinking, hey, that's phenomenal news. Wouldn't that be the best thing ever for the buyer? The buyer's dad's a builder, very obviously qualified in this space, and just wasn't sure if the sellers were going to come to that point of fixing it the way it should be. And that's the grey areas of P&B, pest and building things, is that they can say yes, but how will it be of that quality? We shared our thoughts and felt comfortable to say, hey, it's going to get done. We've dealt with this agency before, but they made the call to go, look, it's not that I don't trust you. I want to do this, but I also have family in my ear, and it's important that we respect our family, the decision. I would never, ever go someone, hey, tell your dad. No, we feel otherwise. And so we did the right thing and called up the seller side and said, hey, we need to end the deal, but this is where it gets interesting. Well, hey, we agreed to fix everything. What do you mean end the deal? On what basis? Everything's agreed to.
Yeah.
And that was interesting. And the lawyers had an interesting discussion with each other. And then this is where I felt that, hey, look, there's clearly an upset vendor. There's clearly a sales agency who needs to support that vendor, but I've also got my buyer. And so I said, okay, well, I have my rule of property. Give me a 60-day settlement. I don't have the pre-approval just yet, but I'll figure it out. No finance clause. These aren't things that I, say everyone should do, but I feel comfortable in this through the years of experience. And obviously I'll waive the P&B clause, but I need you to refund that person's deposit. So that was the first purchase, Phil, in Townsville, in the suburb of Annandale.
Annandale. I've never been to Townsville, so I have no idea where Annandale is inside of Townsville. What sort of area is Annandale?
Yeah, it's a pretty good, your basic suburb in the, not right in the heart of town, but as close as you can get without being, on the water or impacted by a whole bunch of floods or anything like that. Really, really established community. Not a lot of new build or pretty much no new build housing you can put up there. So established, great demographics and right near the centre of town. But the main thing, undersupplied.
Sounds pretty good. And how much you pay?
$412,500 and rented it for $450.
Okay. So what's the yield?
I think if my math's right, it's kind of around that mid-fives.
Yeah, that's okay.
And I think with that yield, this is where Townsville has an interesting point that often comes up for many. It's the insurances.
Yeah.
Now, the beauty of getting cross-state or cross-city experience with investing is that we see where the outgoings aren't as much and are as much. And we apply what's called, a rental reduction on the assumed rent. So, example, if you bought the same property in Adelaide, you would rent it for $410 on a $412,500. It would be the same rent as you getting $450 in Townsville. So we call Townsville the $40 rule. Whatever you think is normal, just take away $40. That way you aren't so emotionally stuck to the fact that insurances are higher. You just focus on the fact that what's the net rent.
So why did you buy? Well, you explained the reason why, but what will this property do over time for you?
I personally think from a market positioning, when we look at all the indicators that we look at, if I start very macro, we're on this cusp of affordability and the conversation of it all the time and how everything's boomed. Well, Townsville's just crossed its 2012 prices. So the person who sold it to me actually bought it for around the same price.
10 years ago.
Which means, 2009, they bought it for just over $400,000.
And that just goes to show, to your point, most property investors own between one or two properties. Probably the reason why is that they bought a property like that 10 years ago, which hasn't done anything.
100%. That would have turned them off it as well. But then now when you look at
how old is it?
90s, I think, early 90s. But I guess now when you look at that shift and go, hey, why do I think the next 10 years will be different should be the core question, right? Well, the first thing is, if we look at it in a macro component, job ads have never been better.
Yeah.
Unemployment reached some horrific numbers in 2016, 10.2, I believe.
Yeah.
Crime was at an all-time high during that period. What happened is all levels of government rolled their sleeves up and said, let's get the multi-billion-dollar city deal in place. Now, everyone feels that infrastructure alone or job ads or unemployment alone is the one core thing. That's not the core thing. Otherwise, if it was, I would have been investing there in 2016 or 17, which I didn't.
Yeah.
What happens is that's your macro lead stuff. That's to say that something may happen here, but it hasn't happened yet. We then start going to our more indicators and we start to see a picture. People selling faster, buying more, less is available, rents are booming, rental vacancies are in a crisis, vendor discounting's falling. Long story short, there's change in the air and sentiment and stock levels that caused price uptick. Now, to give you some context, whilst many parts of the country are slowing, many parts of Townsville just in the first quarter reported 1% to 2% month-on-month gains.
Okay.
So that puts it in the line with your Adelaides and parts of Brisbane that achieve somewhat similar results, which makes me feel there's a good ride ahead, but we just got to be patient in this market that's just starting a new cycle.
Yeah. Okay. And also Bundaberg you've bought.
Yeah, this is, I call this a little unicorn. This rarely comes up. To give you some context, the last time this came up for me in my portfolio was 2017.
Okay.
Back in 2017, I purchased a unit block in the market of Burnie, Tasmania. Beautiful Burnie, small
Northern
town.
Tasmania, isn't it?
Northwest.
Yep.
And that property unit block I purchased for $365K.
How many in the unit?
4.
Okay.
2 bedders for 3 of them, 1 bedder for 1 of them. Now, the success story around that is that was just the start of the regional Tassie boom.
Yeah, you would have done well there.
That doubled in earlier this year's valuation to $785.
Okay.
We took out equity, purchased more properties, but we also injected $150K in a renovation project. The rents for that property are now on track to be $1,200.
So you renovated the whole block.
The whole block.
Yeah.
Outside, inside, paint, carpets, everything.
In every property, in every
single
okay.
one. Yeah, so it was a good.
So did you chuck everyone out and do it, and then let them back in, or
progressively?
Yeah. Okay.
We had them leave, or them feeling like, hey, I'm finding somewhere else, or maybe the rents are increasing. I'm not comfortable with it, so they moved on. We've still got 1 more unit to go.
Yep.
But based on the 3 valuations of the first units, it's on track to be just over $1 million for the whole block in value.
Good going.
So that one was a strategy to me that goes, hey, I've now built a few properties in the portfolio that make me feel comfortable to say, I've got enough houses to do your heavy foundational lifting. I don't mind targeting another unit block if the opportunity arises. Again, same rule, 60 days, no finance clause. And with anyone wondering what's the go with this no finance clause, I still chat with my broker. It's not like I leave him in the dark and say, hey, I need you to work this out.
You're giving yourself options.
Exactly. I get a chat with them to go, would you feel comfortable based on these numbers? I'm not asking you to guarantee me, but is there buffer? If there's no buffer, I won't do it. But if there's buffer that in case you put a 0 in the wrong box in an application form and you made it realize, hold on a minute, that's not how high your borrowing cap is, it'll still work, just let me know.
Yeah.
Hey, Arjun, you'll be fine. As usual, self-employed, a little bit more complicated. Give me 60 days just in case plan B is needed. But then what was different here, Phil, was actually the pest and building clause. I'm not a builder, and I'm not saying I have that builder skills, but I knew I was going to renovate this whole block in the future anyway. And I realized that even with the pest and building report in my Tassie one that I did, and a clause that I had there, I still needed to do many things many years later because it was a 1970s block.
Yeah.
So over here, I feel like, hey, if I'm going to have to do many things, I just need a trusted contact to go by. I need a property manager's entry condition report. And the beauty about unit blocks for any investors buying them is agents on the selling side hate inspections for them. They've got to bother every single person, coordinate 4 different times.
Hard work.
And you might not even be interested.
Are these strated or are they?
Already on separate titles, and this is the beauty about bulk buying strata ones.
So did you put all the same lenders or put different place with different lenders?
Well, because it was a 3, NAB was fine to do it.
Okay.
They didn't say, hey, we can't do this or that much lending's needed. But one thing that comes up that's interesting is that this was off market as well, and I was able, due to the no P&B clause, no finance clause, and a seller whose situation was that they're overseas, they needed to liquidate, they're based up in Indonesia for whatever their personal reasons are. And because we've got an agent on the other side who goes, I can't be stuffed doing 3 different inspections. We've got it for cheap.
So did the agent call you up saying, hey, this is rocked up, do you want it? And you just went, yep.
Pretty much.
Yeah.
And so as a result, that was $581,000.
For 3?
For 3.
3, what's it? Is it like a 3 townhouses side by side?
2 bed, 3 bed.
Side by side?
Yeah.
Yeah, okay.
All sharing walls on that side. That rents high 7s, and it has room to go up in current condition to mid-8s. And after some renos, that could go up to 1K plus in rents. And
there you go.
Yeah. I mean, my favorite thing about that one, Phil, was actually the valuation methods. So what happens is when you buy property like that with separate titles, all of it's an inline valuation because you're buying it as one transaction. And as you know with values, they'll never say it's worth more than what you purchased it for.
Yeah.
No matter how sweet the deal is.
If you actually get if your valuer comes back at your purchase price, you can pretty much guarantee you've probably made a few bucks on the way in.
Yeah, exactly.
Yeah, particularly in this market.
And so what the beauty about his valuation report was, at the end of it, he leaves a comment saying, what would the values be on an individual basis? And the individual basis unit value comes up to $680,000.
And what'd you pay as an aggregate?
$581.
Okay.
So that was the big winner in the soul. Yeah, no, that's why the yields are so high, because typically they wouldn't be that high. They'd be around the 5 to 6%.
Yeah.
This one's 7%.
That's one of the benefits buying in bulk wholesale, right, is what you're doing. I like unit blocks. I'd like to get some more myself. A lot of work goes into it, but much better. Arjun, mate, time's flown by. I really enjoy catching up.
That was good catching up, mate.
Very, very cool. How long have we been going for? 45 minutes. Wow. What are we going to talk about next time? Come on.
Well, next time I'll have the full analysis of this Australian
we can go
housing.
into that, can't we? This, how many fundamentals? 20.
Well, we've got 28 loaded here.
Okay.
So once all of these are fully fleshed out, we should finish this activity July ending.
Okay.
And it's called Australia's Housing Fundamentals. So
All right. Well, let's get Arjun in August, and he can tell us all about it.
Sounds good, my
mate.
friend.
It's Arjun Paliwal, Director and Head of Research, and it's good with Arjun. He's happy to share his own personal journey investing in property, but also the great work he's doing for his clients through InvestorKit. Give me one suburb, Arjun, where you should be thinking about investing in property right now.
Well, I gave you the one in Annandale and Townsville.
Yeah.
I'll leave that as the main one.
There you go. You can't get anything out of these buyers agents. It's not bad. There's a tip. There you go. Hope you enjoy that, everyone. Remember, smartpropertyinvestment.com.au. Any questions at all around this podcast or anything for Arjun in particular, if you want to have a chat with him, you can go through our team. Editor at smartpropertyinvestment.com.au is the email you need to know. We're going to do a Q&A episode at some point soon, so if there's any terms or any concepts that we spoke about there which are a bit foreign to you, would like more info on it, let us know and we'll make sure we can follow that up. Smart Property HQ on the social medias where you'll find us. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
It's safe to say the property market has been red hot over the last few years, with some of the markets we've selected in 2021 rising over 40% in a 12-month period. It's very likely that if you're a property owner, your property has gone up 20% minimum in value in the past 12 months, and you have most likely accrued sizable equity that can be recycled and extracted to build your investment portfolio. With interest rates increasing, you might be wondering where to invest to maximise capital growth and cash flow in 2022 and beyond. Well, to save you time, energy and guesswork, award-winning author and regular guest on the Smart Property Investment podcast, Paul Glossop and his team at Pure Property Investment have outlined the top 30 affordable suburbs poised for strong capital growth over the next few years with sound cash flow. Grab your free Top 30 Guide to Property Investment guide today at purepropertyinvestment.com.